Good afternoon, everyone, and welcome to our Investing in What Matters to You webinar. Today is one of a series of webinars in recognition of Financial Literacy Month, and we will invite you to register for the rest. My name is Steve Eng, Director of Growth Strategy here at Vancity. First off, I'd like to begin by acknowledging that Vancity operates on the unceded lands of the Coast Salish people, represented today by the Squamish, Tsleil-Waututh, and Musqueam nations. I feel immense privilege in being able to live and work on these lands and wish to pay my respects. So let's start with a few housekeeping items. This webinar will be recorded and shared with registered attendees. It will also be posted to our YouTube channel following the event. As such, we've turned off all incoming cameras and muted your microphones. If you haven't already, please make sure you follow us on YouTube and our various social media platforms to stay connected and get access to great content like this webinar. The Q&A button allows you to submit a question that will be reviewed at our question and answer period at the end, moderated by our regional manager, Graham Aldridge. With that, I'd like to now introduce you to our speakers for this webinar. First, we have Kelly Hirsch. Kelly is the head of ESG with Vancity Investment Management Limited. She is responsible for assessing the policies and practices of publicly traded companies to determine eligibility for investment. Kelly is involved in developing and executing shareholder engagement strategies as a component of portfolio risk management. She holds a Bachelor of Environmental Science from the University of Guelph and a diploma in accounting from the University of British Columbia. She is a CFA charter holder and is certified as a responsible investment specialist with the Responsible Investment Association of Canada. We also have Morgan Simpson Moran joining us, who is an associate ESG analyst with Vancity Investment Management. Morgan works to identify risks and opportunities via research, analysis, and outreach. Prior to joining Vancity, she spent 3 years as an analyst at a climate think tank, working to find innovative solutions to modern social and environmental issues. Morgan holds a Bachelor's of Economics with distinction from the University of Alberta, as well as a certificate in energy, resource, and environmental management. So I'll start off by posing a question. Why shouldn't you be able to build your wealth and a better world? An increasing number of investors are choosing to consider both the financial return and the social impact companies produce. This is known as socially responsible investing. Morgan and Kelly will dive deeper and talk about what responsible investing is, why responsible investing matters now more than ever, our climate risk strategy to generate positive impact in the world, how engaging with companies is a tool to reduce risks, and how sustainability is tied to financial value. With that, I'll turn it now over to Morgan.
Hi, everyone. My name's Morgan, and I'm going to give you a primer on ESG and responsible investing today. So ESG, or environment, social, and governance factors, are 3 additional pillars we look at to try to understand how a company will perform. Knowing how a company treats the environment, the employees within it, and its community, and how it governs itself is a key performance indicator and gives us great insights on how a company will perform going forward. Next slide, please. Each letter in ESG is effectively an umbrella, and under this letter is a series of concerns and opportunities that we look at when analyzing companies we hold. So, for example, does a company do adequate work to mitigate its pollution? Is it facing undue risk based on its carbon emissions? How is it contributing to the loss of biodiversity? Furthermore, do they have forced labor in their supply chain? Do they provide their employees with adequate health care? And how do they govern itself? Is there diversity on the board? Are there conflicts of interest present? All of these factors are risks and opportunities that are core to what we do. Next slide, please. So, responsible investing is effectively taking these ESG practices and rolling them into the investment process that we do every day. So, each company, we're looking at how they impact the people on the planet and how they manage their own operations. Next slide, please. And in responsible investing is a spectrum. So, in this sort of financial world, you've likely heard about a lot of different types of investments: socially responsible investing, sustainable investing, impact investing, and these are all housed under that RI term. So Vancity Investment Management exists within 3 of these subsectors. So what that means is we're delivering financial returns, we're mitigating ESG risks, we're pursuing ESG opportunities, and we're constantly focusing on high impact solutions for the community, the environment, and so forth. Next slide. Thank you. And how do we do this? We take a 2-pronged approach. So to start, we do not invest in any company whose primary line of business is from fossil fuels, adult materials, military weapons, nuclear power, tobacco, or gambling. But just because a company doesn't involve themselves in any of that doesn't mean they're good to go. They can be part of our funds. We also want to make sure that we're including only the best of the best in our funds. The way we do that is by examining their practices on corporate governance, product sustainability, employee relations and diversity, community relations, environmental performance, and human rights practices. Next slide, please. And encompassed into this RI practice is our climate risk strategy. So as I mentioned, it starts with divestment. This means we eliminated any companies whose primary line of business were from extraction, production, or distribution of fossil fuels. But we didn't end it there. We continue to constantly decarbonize by avoiding companies with above average emissions, energy use, or production costs. Next, we take any funds that came from that to reinvest in sectors and companies we feel are primed to exist in a low carbon society and economy, whether that's alternative energy, transitional technologies, green transportation. There's many sectors to invest in. And lastly, we're constantly engaging with the companies we do hold. Just because they don't meet those criteria doesn't mean they're automatically given a pass from us. We want to make sure they're working to increase their disclosure on climate risk and understand the risks that they face every day and how those risks are evolving with regards to the climate environment. Next slide, thank you. So to ensure that we are on the right track and achieving our desired goals with these funds, on an annual basis, we evaluate our portfolios for their alignment with the UN SDGs. These are effectively 17 goals set out by the United Nations to help the world work towards being better. By evaluating that, we know that we are doing the best we can. And next, I'll pass it off to Kelly.
Awesome, thanks, Morgan. Yeah, so Morgan's already gone through kind of the core of what responsible investing is, environmental social governance. Apologize, I'll probably end up saying ESG and using a lot of acronyms. But yeah, so just, environmental social governance, ESG, SRI, socially responsible investing, RI, responsible investing. And so, yeah, she's gone through a lot of the kind of core processes when you're putting together a fund, choosing to invest in companies, looking at the overall companies we invest in, the potential climate risks they face, where there are actually as well, opportunities on the climate side too. So, but I think also, so that is an important part of responsible investing. But there's also, really what I'm here to talk to you today about is the other part of responsible investing that I think is a really key piece and really what defines our our process, and really in my mind is something that's really important in any RI strategy, and that is, so it's shareholder engagement. And this is basically, it's where, as investors, we are de facto, we are owners of the companies that are in our portfolios. And that gives us leverage to, talk to these companies about, a variety of issues, particularly. So when I'm talking shareholder engagement, I'm really talking about talking to companies about how they're performing and how they're managing risks on the environmental sphere, the social sphere, as well as the governance sphere. And to highlight this, I think analogies can sometimes be helpful. And so I like to think of this as really sort of us shareholders as owners. So let's take a restaurant. If you had a restaurant running, you've got your employees there, and the owner has hired a manager to oversee the employees. So it can be very well run, but let's say you find out, oh, the owner's coming tomorrow. Well, you're going to be, doing, I mean, yeah, sure, you can be running things well every day, but if you hear the owner's coming, you're going to be, cleaning out the fridge, scrubbing down the ovens, polishing the tables, taking extra care. And that's really, and from that, I think that's something where, as owners, that's a power that needs to be used appropriately, that needs to be used to highlight these, these risks that companies face. And this can be often too frequently over the past few decades. I think we've seen a lot of investors, not Vancity, but I'd say, the whole ecosystem. There's been such a focus where companies, all they hear about are profits, finances, profits, finance, and that can get very short-sighted. And so this is where it's really important for companies to be hearing from their owners, their shareholders, about issues that have financial impacts, but often you may not see that impact in the next quarter, but you're going to see that, and it's going to impact the longevity of the company overall. So that's sort of shareholder engagement as a concept. On the screen here, we've got three strategies that we use for this. One, simply direct dialogue with companies, having those conversations, having, reaching out to a company and saying, hey, we want to talk about, how you're managing human rights risks in your supply chain. We may, reach out to a company. How are you, managing, the potential pollution that your operations could generate? And so that's more on the informal side. And that's where a lot of engagement occurs. Moving to shareholder resolutions, which are also sometimes referred to as shareholder proposals. So if you hear either term, it's referring to the same thing. What a shareholder resolution is it's, as shareholders, we have the right in Canada and the US, and some other countries as well. We have the right to ask a company to include in their annual general meeting a request for the company to do something. For instance, if a company wasn't reporting on environmental social governance, like they didn't have a sustainability report or an ESG report, or sort of the different names that are used for that, if they weren't providing carbon emission, the disclosures of what their carbon emissions are, that's something where, let's say, we might have dialogue with a company, and then if that's not going somewhere, we may go and file a shareholder proposal or a shareholder resolution where we ask the company, okay, we would like to see, we propose that you start providing this disclosure. And then that will actually be published in their annual general meeting minutes. And all shareholders, other investors, other shareholders can vote on that and say, yes, we want to see more disclosure, or no, we don't. And that's a really powerful signal to companies to do that this is something that their investors, their owners care about. And so on the flip side of that, on the right of the slide here, proxy voting. Proxy voting is, in a sense, almost the other side of that. If you're a shareholder in a company, you can, if you see another shareholder, shareholder one has asked a company to provide ESG disclosure. If you're a shareholder two, looking at that, you can vote forward that proposal, to communicate to the company that you want the company to do that. And I think this is a power that is sometimes underestimated. And that's where I would go back to the restaurant example, where if you're working in a restaurant and the owner only cares what the front of the house looks like, never looks at the oven, never looks at the fridge, you're never going to go and clean that. You're going to go, well, okay, well, I better focus on the front today. And that's why shareholder engagement is so important, because it can make sure that companies are paying attention to long-term risks that really they may not play out in the next 3 months, but they will play out. And if a company isn't appropriately managing these risks, it will harm their financial performance in the long run. And so with that, today, I'm going to walk through a few examples of issues that we've engaged on. And that's where, so the bulk of my presentation is going to be in the direct dialogue and shareholder resolution piece of it. So to start, looking at, I'm going to sort of cover a few. This is not by any means comprehensive, but I'm going to start with a few examples of where we've used shareholder engagement to push companies forward and to take action on environmental, social, and governance issues. So here's a couple. First, I want to start on the environment side. These are, I'm sure many of the people on this call will be very familiar with both these issues, but if not, so we're looking at, climate change is obviously a very, serious risk that we face through, with carbon emissions and greenhouse gases in being put into the atmosphere. And on the other side, though, a lesser known but equally important piece of the environment is what we call biodiversity, or sort of nature. I think of it as ecosystem health, because really, when we're looking at sort of the environment, often the focus entirely goes to climate change, and that's important. It's a very important. It's a key piece of it's something that we focus on, and is so important to be addressing. But if we're only addressing carbon emissions and that piece, we're not addressing the fundamental sustainability, which is where the biodiversity piece comes in. And that's looking at really about like ecosystem health. I think a lot of us intuitively understand that we rely, our economies, in a sense, are built on the backs of the benefits that nature provides, whether that be pollinators for, the food that we eat, and that can run in, there have been estimates, showing in the billions of dollars, the value provided there. We've also seen, that can also go to, providing clean water, where, sort of certain ecosystems, when they're maintained, when you can, keep pollutants out, and other animals and the ecosystem there, that, provides a lot of benefits. I've seen figures that about half the world's GDP is directly reliant on services provided by nature. And that's why preserving biodiversity and preventing biodiversity loss are such important environmental issues. And it's why we look, for us, our two biggest areas on the environment, climate change and biodiversity. And we think both are very important to be addressing. Before I quickly that I've got the TCFD there and the TNFD, which is the Task Force on Climate-Related Financial Disclosures and the Task Force on Nature-Related Financial Disclosures. And this is really, these are frameworks that companies can use to report and provide disclosures on how reliant they are on these, sort of service ecosystem services, and how, what the risk they face if they were to, through climate change or through biodiversity loss. And that's important because, really, I know it's a cliche saying, but it's so true. What gets measured gets managed. And so a lot of our work in this has been, getting companies to take steps towards this. So on biodiversity, for instance, we've been engaging with Costco on the need for them to evaluate their impacts on biodiversity and nature, both their impacts as well as how dependent they are on this, to be able, to bring the goods, the goods that we expect to when you walk into a Costco, the things we want, you expect to see there. They come from nature. And so that's something where we've been working with Costco to see them improve on this and, start measuring where their potential exposure is there so that they can help better prepare and protect these, these resources they rely on. And then on climate change, one example of engagement we've undertaken there is that we filed a resolution with, the large financial institution, JP Morgan Chase, asking the bank to ensure that they implement policy, lending and financing policies that, prevent them so that they're not contributing to new fossil fuel supplies or capacity. When we're looking at any credible net zero trajectory to reach net zero by 2050, which is what we need to do to stave off the worst impacts of climate change, we're asking them, and we continue to engage with them on this, to ensure that they're not putting their money into projects that are going to harm our climate in the long run. So those are a couple examples on the environment side. On the social side, which is on the next slide, thank you, so we also, often in ESG, the environment gets a lot of focus. Social's a very important piece as well. Not just from like the moral imperative to, prevent human rights abuses or, to treat employees well. But these are actually, yes, there is a moral imperative for sure. It's the right thing to do. But beyond being the right thing to do, it also impacts long-term financial performance. And so that's where, just to sort of, I've got a couple examples. We engage on a lot of different areas here, but a couple examples here really are focusing on the employee relations side, and how a company is treating their employees. And also, as I walk through a couple of these examples here, I'm going to highlight the shareholder resolution process in a little more detail, because I think examples can be really helpful to understand sort of how that process actually looks. So, to start sort of on the human capital side, though, arguably these are both in the human capital side, but on what I would call the human capital side, this is where we have filed a shareholder resolution for a couple of years now with CVS Health, which is more and particularly focusing on their retail employees, their retail stores in the US. And so this is where we did identify the pandemic really highlighted the lack of certain benefits that, frontline workers have that they really need. And that one of those would be, paid sick leave. This is not just about, doing right by employees. It's also reduced costs when you can allow your employees to take time. You can reduce employee turnover. It can prevent the spread of illness. You want to incentivize employees when they're sick. You don't want an employee to have to make a choice, right? Like Do I feed my kid, like go into work, earn the money that I need to feed my kids? Or, do I stay home, or do I protect my coworkers and staff, and stay home, but then lose out and not have, that financial, to lose out there and not be able to, and have a financial harm. And that can result in higher turnover. That can, sort of result in more employees getting sick and seeing more lost productivity. And so this is something where, as one of many, Vancity, we really like to take the lead on these issues. And so this was actually the first shareholder resolution that has ever been brought forward to a vote, asking a company to adopt a permanent paid sick leave policy. And we've had some good conversations with the company, and that continues. To actually walk through the shareholder resolution approach and what that can look like, I'd like to walk through some of our living wage engagements. And so quickly, living wage. This is something Vancity is a living wage employer. And a living wage is the wage that someone needs to earn to be able to, pay their rent, put food on the table, cover their basic expenses. This doesn't have them going, taking trips to Hawaii or it's really about covering your basic costs. And unfortunately, today, the living wage is higher than the minimum wage. And this is why we think this is an important thing for all companies to ensure that they're paying their employees, at minimum, a wage that enables them to cover their basic needs. So we have, there were two companies we identified as wanting to learn, to learn more about their wage policies. And so one was Chartwell Retirement Residences. The other was NFI Group. So Chartwell Retirement Residences, as the name suggests, they have retirement homes, long-term care homes. The pandemic has really highlighted what a vital service they provide, and the workers and the risks the workers face, and that are involved, that work in these facilities. So, and then NFI Group is a bus manufacturer. That have, they provide, they manufacture a lot of electric buses, and they're really critical to the climate, sort of decarbonizing our transportation network. So with both companies, we asked both companies to evaluate their pay practices in relation to a living wage by filing shareholder resolutions with them, asking for this. So I know I've talked a lot about, resolutions going to a vote, going to the annual general meeting for other shareholders to vote on it. That doesn't always happen, because really, when we file a resolution, it's not that we want shareholders to vote on it. We want the company to do what we're asking them to do. So when we filed this resolution with NFI Group, we had some really productive dialogue following this resolution filing, where the company agreed to evaluate their workforce wages in relation to a living wage. And following that, they identified a very small portion of their workforce that wasn't earning a living wage, and they rectified that and made sure that, and they're exploring right now becoming a living wage certified employer, much like Vancity Credit Union is. So that's one way. A shareholder resolution doesn't need to go to a vote, but it can be that little extra leverage that as shareholders we bring this forward, and we can get the company to take that action, and which really will help the company in the long run. It'll help protect our investment, and it will help the company be more successful. On the other side, though, so we had Chartwell Retirement Residences, where we had some good conversations, but we weren't able to come to an agreement. So that resolution did get brought forward, was brought forward to a vote. And we continued those conversations. And this was honestly something where and I think this is it's actually an important piece whenever you're looking at ESG funds and RI funds, do they exit companies that aren't aligned with their values? And so this was something where, we continued these dialogues with Chartwell, but we didn't see the company, given how important the long-term care, like living wages are in the long-term care sector, we weren't seeing them make progress on this. They weren't taking the action, we weren't getting sort of results from our engagement. So we did exit and we sold the company from the funds. So those are a couple to let you sort of see how the shareholder resolution process can play out. And then sort of finally, on the sort of governance side, which, and actually in many ways, this highlights that a lot of ESG issues, they don't fit neatly into one box, like just into E, S, or G. And that's why I think it's actually really important for investment funds to be looking at all. You may see like, environmentally themed funds or sort of a fund that's looking at one aspect. Whereas a lot of these, there's overlap, and we're really only going to see progress if we're addressing them all. So on the so for a couple examples here on like the governance side, we have sort of access to medicine is something that, even prior to the pandemic, was a key priority of Vancity, where, Vancity Investment Management and our funds, where, we are a member of the Access to Medicine Foundation, supporting engagements with companies to ensure that they are putting the right, there's a lot of wonderful drugs that, pharmaceutical companies make, and we need to make sure that the people who need them are able to access them and that financial barriers are not preventing that. And so, in the past, we've done a lot of engagement directly. This would actually be sort of pre-pandemic on like insulin pricing for diabetics, because that's been in the US a serious issue of concern, as well as sort of other with some of the pharmaceuticals we've held, other like key drugs that grew, that price was potentially stopping people from accessing. Most recently, though, we have engaged with pharmaceutical companies, encouraging them, and this is where the governance side comes in on access to medicine, where if you can tie executive compensation to achieving access goals, it's amazing what, if you pay people to do something, and that's what they're, incentivized to do, we often can actually see that's where you see movement. And so that was something, as sort of as vaccination, and we were seeing particularly earlier on in the pandemic, where developed countries were accessing vaccines, but you weren't seeing, we were seeing a lack of vaccines in sort of developing countries. And that's something where we've been encouraging pharmaceutical companies to ensure that executive compensation is tied to vaccines getting to more people and having more people having access to them. So that's one example of, and that was on the sort of directed dialogue sort of bucket on governance, and that continues. And we're looking at, sort of expanding that through other vital drugs that people rely on. And lastly, governance and inequality. So this is, I think, it's something that the scale of the problem, most people feel this, this, right? Like we see there's sort of this class that's getting quite wealthy. We see CEO pay, you see the headlines, it's through the roof every year, it feels like. But it's not anecdotal. There are numbers to show how much over the past few decades, the fortunes of executives and everyone else have divided. So if we go back to the US, actually is better, unfortunately, the US has better data than Canada, but the trends are quite mirrored, honestly, when we're looking at executive compensation, quite similar. So if you're looking at the US and sort of the largest companies, they have seen CEO compensation has increased since 1978 to today 1,460%. The average worker over that time period has seen their real wages increase 18%. And this is a systemic issue for investors for a variety of reasons. For one, there is much research tying growing inequality to it's bad for society, increased crime, poor healthcare, poorer social connections, community life. You start to get, I mean, that's the gated community, right? You have the that divide. You start to have that less of a cohesive society. But more than that, you have within a company, it's bad for employee morale. There's lost productivity, higher turnover costs. It's not, if you know your seat, if you're working, I mean, everyone's generating value for a company. If you're working hard day in and day out, and you just see consistently the CEO and the executive team is making their wages go up 20% each year, and you're seeing 2%, that's demoralizing. And that is hard. And it's the day-to-day employees are key for a company to create value. And that's why this is such an important issue. And so I think actually getting to, so this is something where Canada actually doesn't mandate this disclosure right now. It is mandated in the US. We've seen in that same time frame from 1978 to today, we've seen CEO compensation go from 31 times a median employee to 399 times a median employee. Canada, there are estimates. These are not, and this is actually why we're engaging on this, because there are only estimates today, that Canadian CEOs make about 191 times what the average worker does. And so it doesn't have to be like this. And this is something where, and so actually, I mean, because honestly, I'll tell you at Vancity, we provide this disclosure. And our ratio is 13 to 1, is what our CEO makes in relation to the median worker at Vancity. And so this is something where we really want to see Canadian companies start providing this disclosure and tracking this, so that we won't see, to try to get this gap needs to be reduced. And the only way we can do the cheesy saying, what gets measured gets managed. And so that's why we've been filing shareholder resolutions with the Canadian banks that we hold in our funds, RBC, CIBC, TD, and Scotia, asking them to provide this disclosure. Scotiabank has agreed, and we will be seeing those numbers next year. And we are currently working, we did bring this to a vote at RBC, CIBC, and TD last year, and we continue to work with the companies to encourage them to provide this disclosure and then start managing their wage practices on this. And so this really highlights the long-term nature of shareholder engagement, and that it's about small steps. It's about continually working with companies, and it's how you can really see long-term change. I always say, there's not going to be a day, like for instance, with climate change, there's not going to be a day that we have a big banner and we say, hey, climate change solved. Hey, economic inequality done, finished. It's a work in progress. And it's about every day getting up and taking those small steps, pushing companies to do better, which will help protect our portfolios from these financial risks and make the companies we invest in better overall quality companies. And so with that, on the next slide, I would highly encourage, if you found this interesting, some of the examples, these were just sort of a few highlights of some of the work that we do. I highly recommend taking a look at vcim.ca, and we have our shareholder engagement report, which outlines as a comprehensive coverage of some of the issues we engage on and what we've done and what companies we've talked to, and can really help you understand that. I think it's a great, something important, because not all ESG funds do this, not all responsible investment funds do this, but I would argue that all should, like if you want to call yourself that, all should. And it's such a key part of the responsible investment process. And with that, I will pass it over to Graham.
Kelly, thank you so much, and Morgan likewise as well. As Steve mentioned, my name is Graham Aldrich. I am one of our regional managers. I represent wealth advisors and wealth planners in our Vancouver and Richmond markets. Enough about me. We have some really interesting questions for our two presenters today. Thank you both for the really interesting, insightful information. I think it's quite rare for the layperson to hear what goes on inside a money manager, so my appreciation for that. The first question I have slated for you, and maybe Kelly, I can pass this one to you. So the question is, you do choose to not invest in certain industries in your portfolios, but from an investor perspective, would I lose out on any diversification in my portfolio?
No, that's a great question. So there are obviously, different investment managers have different thoughts on this. We strongly believe, and I would say our performance, we have over a 10-year track record on this. We strongly believe that not investing certain sectors are, in the long run, are not going to be financially profitable. So we look at like fossil fuels, for instance. Sure, there can be short time periods, like right now, there's been geopolitical developments right now where, we've seen that happen, sort of fossil fuel rebound. But if you look in a long term, it's often a losing investment. And so for us, it's about diversifying. Like, we're looking to capture opportunity. We want to be invested in the companies that are going to grow in the future, not, renewable energy companies, like companies. I would actually argue, I think water infrastructure is a big piece too that people often forget about when we're looking at climate change. Climate will be felt through water in many ways. It's about, droughts, heat waves, flooding, storms. And so doing a better job of managing water is a key piece. So that will be something where, we're always looking to diversify into areas that are growing versus we avoid areas where we think that we don't see the opportunity in the future for it. And in the long run, like that, we're long-term investors. We're not day traders. We're not. That's a different. Hey, if you're getting into that, it's a different place, and that's fine. There's a place for that. But for long-term investment, we think that this will actually, just being diversified into everything. You don't want to be diversified into the losing sectors, in my opinion.
Excellent. So very much a forward-looking strategy, still with diversification in mind. And I do appreciate that forward-looking aspect of it, as opposed to considering what may be challenging or broken today. Thank you for that. Morgan, I'll pass this one over to you. So this is regarding new technology, or I was reading a little bit earlier about battery technology, solid state. There's all sorts of things happening here. But if you were to look at potentially a new technology, and maybe we could use the battery as technology as an example, at what stage of development would VCIM become interested in that? How would you start to evaluate that? Could you maybe expand a little bit on maybe particular technologies or that concept as a whole?
Yeah, so I guess a little bit of background that I would give on that is, unlike many other firms, the way our investment process works is we work very closely with our equities team. So they are the folks who are bringing us companies to evaluate through an ESG lens. So any technology, any opportunity, we're always open to, especially if it's contributing to transitioning to a lower carbon society. It's a great question of at what point do we invest? It's tough to say based on any given technology, but the decision would ultimately be made with both ourselves and our equities team, we would come to that conclusion. We would decide this is something we want to invest in, and take it forward from there. And it is an exciting time to be a fund that that takes a look at that so seriously, because there's so many new technologies and we're seeing so much rapid change every single day. So this almost ties into the diversifying your investments question a little bit too. Of yeah, it's exciting. There's a lot coming, and we are watching it constantly.
Great. Thank you, Morgan. So I very much understand that it's both a technological evaluation, but also a financial or financially sustainable evaluation from your portfolio team. Okay, that's a great distinction there. I appreciate that. Another question, and there's been the term greenwashing in the news. I don't like to throw it out because it's often used and often misused, perhaps, but there have been some articles in the news recently about greenwashing. What are some of the things that we perhaps can do to improve knowledge around that, or provide clarity maybe to the general public, the investing public, around that greenwashing concept?
I'm happy
And
to,
Kelly, if you want to take that one, thank you.
Yeah, sure. Sorry, jumping in there, but yeah, no, that's something I think is really no, it's so that's actually something. So it's been really, we've been doing this a long time, right? I mean, it goes back to like Vancity actually launched the first SRI mutual fund in 1986. This is part of our like blood. We've for a long time been arguing that the ESG factors are material for financial performance. So it has been great to see during the pandemic the interest of other more traditional financial players that used to, sort of say, well, no, this doesn't, that is nice to have, but it's not material to financial performance. It's been nice to see that increased interest, but much like in any new emerging exploding field, you get a lot of players that come into it that may just, they can just with the lack of right now, the two biggest problems is lack of regulation and lack of standardized disclosures. And so it's what makes greenwashing a big problem right now, because without the regulation and without standardized disclosures, you can get funds that just say, hey, we're ESG. Hey, we're doing this. And what does that really mean? So I think, though, that honestly, actually coming here today to learn a bit about, like from people like us that really have been, we've been doing this for a long time. This is one thing you can do. Learn a bit more. You don't need to become an expert. You don't need to, obviously, like that's our job, like that. But it's sort of learning a bit more about, and I'd say actually shareholder engagement being a big piece. If you're looking at, trying to make a decision on, who to invest with, ask those questions. Well, is the fund are the investments, do they engage on ESG issues? What is their voting record? Like, are they usually voting again? Sort of, do they vote when someone brings forward a shareholder resolution asking for like climate change disclosure? Do they vote against that? Like, are they voting in line with their values? And also, is that actually in their like what we call the prospectus, the like official investment documents? That's something where for us, we have filed with regulators, we are audited by, sort of auditing firms on our actual incorporation of this. It's not something that's just on, because you can get that where you can have sort of just in a marketing thing, but if you're actually looking at any of the paperwork, it's not built into that. There's no guarantee that they'll keep, that the fund manager will keep doing that. I know it's a hard, and it is a hard one to identify if you're not an expert, and that's actually why we closely follow and encourage improved disclosures and regulation on this issue, because I think that in the long run, that's really what's going to help weed out kind of your snake oil salesmen, the people that try to just sort of put, well, hey, this is great, but aren't actually doing the work behind it.
Fantastic, Kelly. You had mentioned the shareholder engagement report. I think that's a source of some really interesting additional information. I'd encourage everyone who's tuning in today, or perhaps those who are listening in recorded view, to check that out. Definitely provide some examples of some of the things that you've highlighted, as well as some other areas that you're focused on. So thank you for that, Kelly. The next question is actually something I will pass to myself. I'm not supposed to be asking myself questions, but the individual wanted to really just learn more about responsible investing. This is an abbreviation here. But this person had said that they're not someone who has a large investment portfolio, and they were curious on how they would start connecting on that conversation, and perhaps Vancity is part of that. As a person who supports advisors and wealth planners in my area in Vancouver and Richmond, but certainly there's likewise similar positions across our network. I would encourage you to engage with an individual at the branch level. We have folks in our branches. We have advisors across our network, and certainly feel free to drop us a message on social media. Check out our other social channels as well. I think that the important part is just to start the conversation. Be curious, Kelly, as you had said. Morgan, I will stop asking myself questions and I will pass over to you on this next one. This one it talks a little bit about potential returns, and I think that's maybe a concern that some folks have had. If I was to invest using an ESG theme or as a responsible investor, do I lose out on potential returns? And perhaps what additionally might an investor get when they chose to use VCIM or choose an investment option that was managed by Vancity Investment Management?
Yeah, absolutely. So I'll speak to the first part on a very high level. There have been a multitude of studies done looking at various indexes and composites that show that no, you don't necessarily lose out. There's individual differences between funds and different managers. But I think what I would really like to highlight with that is we are long-term investors, like Kelly said. So fluctuations right now are common with any fund, but what we're ultimately doing is we're taking a look at the long term. We are making sure that in the long term, you're not facing any undue risk that's going to impact your investment negatively. And we're keeping an eye out for that in ways that a lot of other funds don't necessarily, if they don't incorporate the ESG practices to the same extent. And sorry, what was the second part of the question?
Yeah, no, fair enough. In terms of an investor choosing to invest directly with you or through one of the affiliate companies that you do work with, what would they get, in addition to a mutual fund? I think you talked a little bit earlier about some of the things that go on behind the scenes. If there's any other things that you perhaps want to expand on there. Yeah,
well, ultimately you get us. We are a team of folks who are entirely dedicated to making sure that the funds meet our and your standards, so that that you're getting returns and making money that you're comfortable with, that you like, that are setting the world up and for ideally a better future and have less of an impact. So we have a team that is growing who work every day to not only pick good companies, engage on companies, make sure we understand the current problems. We're currently following COP27 very closely, understanding how that evolves and how that's impacting not just ESG isn't just oil and gas, no oil and gas, how it's impacting a variety of industries, companies, so on and so forth. So yeah, in addition, it's our team behind that's always there.
Right, and not only do they get an investment management team, but they get the ESG evaluation team, which is our wonderful presenters today. Well put, thank you. So we've had an interesting year. There's been a very busy year, and I think one of the things that has continued to be in the headlines is conflict. So when there are certain things happening in a particular country or countries, let's say it's human rights abuses, corruption, could you speak to, and maybe Kelly, I will pass this to you, could you speak to how you might deal with that potential risk on the horizon, or something that just shows up one day and then we suddenly have to think, how are we going to pivot on this? How do we deal with one country who is perhaps imposing on another, or has really unfavorable practices?
Yeah, no, for sure. That's some of the hardest work in our job, I'd say, because I mean, in a sense, it's looking at like the big global problems, right? And so, I mean, it's something I would say, and we do, honestly, actually, I will talk, I mean, this is something that came up before the war that Putin started in Ukraine. I would often get asked, like, why aren't you invested in, like, are you invested in Russia? Are you? And it's something, honestly, because we do, like, when we are looking at companies, when we're looking at this, it's not just the company we're looking at, we do look at broader risks. And to be honest, we've never had exposure to Russia, because when we look, like, everything in Russia, even, prior, not let's going kind of before and whenever, actually, I mean, we can also, honestly, looking back, the war started in 2014, really, I think, if we're the Crimea annexation. But looking at that, we wouldn't invest in Russia before. And we tend to avoid investing in countries when we look that would actually lead to, because in a sense, Putin controls everything in the country. And so anything, if we were to invest there, that would potentially help, funnel up to him. So that's something where we've always have looked at that. I mean, we more broadly on engage with. So, I mean, we're working with other investors. We've signed statements, in support of Ukraine, and are looking at, because we don't have that much exposure, the engagement channels there are a little less, like we don't have as many opportunities to engage with companies because we have sort of avoided that exposure. Another geopolitical area, though, that we have been engaging on, sort of looking to avoid where we can, but also understanding that it can't fully be avoided, would be some of the human rights violations that we've seen in the Xinjiang region of China, where there has been basically a government, it's quite well accepted now that there's been, against, there's an ethnic population that is, the government is sort of basically sponsoring some forced labor in that region. So for us, it's actually why we won't invest in Chinese domiciled solar companies, because it's actually, that region has a lot of solar, like the raw material, polysilicon, 45% of the world's polysilicon comes from that region. And so a solar company that's based there, it would be hard for us to find, even if the company's saying they've got clean, that's hard. There's no way for us to know that. And so we avoid. But we can't fully avoid. China is very tied to global supply chains. And so, Western companies could potentially be exposed. So this is where we use our power as, shareholders to engage with companies on ensuring that they are putting in, this, I'm cognizant of time, and I could do a whole seminar on this, but basically, like, that they are auditing their supply chains. They're looking to identify if there are any exposures, and then taking action to remedy that and ensure that they clean their supply chains and that they get that forced labor, they get out, they are addressing human rights violations there. And that's one example there. I mean, we've done with Bangladesh when there's the garment manufacturing, we've done a lot of engagement on that issue, on conflict minerals. And so these are problems that, like, exist in the world. And so, and global companies can be exposed, usually not directly, usually it's sort of through chains, but that doesn't mean that they can't take action. And so that's something where actually, that's why also the shareholder engagement piece is so important. Because if you're just investing and sitting back, you're not necessarily addressing those risks. You're not ensuring that companies are protected from that. And so that's something where, I mean, you can actually read a bit our shareholder engagement report. I didn't go into as much detail. That goes into a bit of the work that we've done on a variety of sectors and with companies that are potentially exposed to human rights violations in other countries, and sort of what we are doing to encourage companies to improve.
Fantastic, Kelly. So Kelly, Morgan, I really appreciate both of your time. I know you're both extremely busy doing all the great things that you do in the background. So my thanks on behalf of the audience for your time and your expertise today. With that, I'll pass it back over to my colleague, Steve Eng.
Thank you, Graham, Morgan, Kelly, and of course all of you for attending this session. We hope that it helped increase your understanding of responsible investing and how we apply this at Vancity Investment Management. As a reminder, we will share this recording via our YouTube channel by next Tuesday, and all of you will be receiving an email with that link. We also have a couple of upcoming webinars in the coming weeks, one on retirement planning and the other on current market conditions. I welcome you to register to attend. You'll find them via our Vancity website in the About Vancity area under Events. There may be more questions that you have after today, and as Graham had mentioned earlier, we all welcome you to reach out and ask to speak to any of our Vancity Wealth Management professionals. With that, thank you all again, and we hope to connect with you soon, whether that's virtually or in person. Have a wonderful afternoon.